Stephen, thanks for joining us.
Morning, John.
Your research says it's going to ease this year, but next year, watch out.
Yeah, we think we're almost at the end of this cycle. The year-on-year is going to stay above 5 for another 3 or 4 months, but we think it's going to peak out either next month or the month after. It's very important to look at the month-on-month CPI. That's already decelerated in the last 3 months, so that's a good sign. But inflation is not going to go away. I think Beijing has very clearly signalled that they're happy with inflation around 4%. And so at the second half of next year, we think inflation is going to come back, and we're going to see even more rate hikes in China second half of next year.
Some would argue it's going to get even higher. Food inflation for China, wage inflation, energy inflation, etc. So why do you have this thesis that perhaps it's going to ease off second half?
Well, it's a cyclical phenomenon. We're looking, for the last 6 months, banks like us have had their credit controlled, and all the banks have had credit controls. So lending into the economy has slowed down. We've seen those slower loan growth numbers over the last few months. And if we know anything about China's economy, we know it's a credit-driven economy. Once you start pulling back the credit, the economy slows down, and we've seen that in the weaker PMIs. Once you've constricted demand a little bit, inflation pressures should come down a little bit. It's not going to go to zero, clearly, but it will get down to a more manageable level, we believe, in the second half of the year.
Second half of the year, you see it actually getting a bit more aggressive, inflation?
No, it's going to come down to the end of this year, and then next year, inflation will come back. But it's going to mean that once we get the peak in CPI in either June or July, it's going to mean the government can begin to loosen some of those credit controls.
Here's the concern, isn't it? It's the financing hole, it's the credit control, it's the debt. Now, we all know about Europe and the US of debt. No one really thinks about China at debt, but they are building all these buildings on debt.
Yeah, the big 4 trillion stimulus package that saved China and saved the world a couple of years ago, much of that was financed through the banks, and now, of course, the banks and the government's waking up to some of the problems that that's created. So there's probably a hole equivalent to maybe 20 or 30% of GDP in loans out to these investment vehicles, which is not going to come back.
Should it be a worry, Stephen, or not for us?
Well, I mean, it's certainly a concern. We need to really get a control of it. And I think, to a large extent, the bank regulator in China has done a good job of just finding out how much loans are out there, what's the collateral like, and try to slow down the new credit to these vehicles. But ultimately, China's an economy which is growing at 15%. As long as they can get inflation under control, begin to ease up on those credit controls in the second half of this year, I think it's manageable. I think we'll muddle through. It's going to be painful for some banks, but I think the economy will muddle through.
Dr. Doom, Mr. Rabini, yesterday in Singapore talked about a hard landing in China. Do we believe you saying soft, or do we believe Dr. Doom?
Well, at the moment we're slowing down because the government wants us to slow down. When you wander around China, there's so much activity that's going on. GDP per capita is at a pretty low level. Urbanisation is only 50%. And we think there's pretty strong growth, easy growth to come for at least another 5 or 10 years. Clearly there are serious problems in the structure of the economy, all this debt, all the other issues that we worry about. But I think there's probably another 5 or 10 years of easy growth.
Seconds to go. Inflation forecast for you today?
5.4% year on year.
Okay. Stephen Green, thanks for joining us there. Stephen Green, the head of Greater China Research at Standard Chartered Plc.